Hello, I'm Sam Benstead from Interactive Investor. Kyle is out of office this week, so I'm stepping in to host our On the Money podcast, which is a weekly look at how to get the best out of your savings and investments. Today, it's all about US equities. The American stock market has been a juggernaut over the past decade, and driven by growth at its largest technology companies, it now accounts for a little over 70% of a typical developed world global equity index. While profits have grown, valuations have also become more expensive, which has left many questioning whether the US equity boom is sustainable. It's an especially important question right now with Donald Trump introducing tariffs on key trading partners and US shares dropping in value this year. To help answer these questions, I'm joined by Felix Wintle, manager of the Tyndall North American Fund. Felix, thanks very much for coming onto the podcast.
Hi Sam, thanks very much for having me.
So it's been a tricky few months for the US stock market. So how much of that is down to political uncertainty with Donald Trump back in the White House?
I think it's a very large part of it. I think the market's really sort of been contending with a real unknown around tariffs, obviously, but also there's some real concern around the impacts of Doge, which is the effort to sort of control government spending and cut costs from the government side, and what that's going to mean for GDP. So I think the market's gone from a sort of a honeymoon period post the Trump election where people were excited about reforms, basically, which I think were much needed. And it's now we're sort of looking at, okay, well, the actions that Trump is going to take will have consequences for the economy, i.e. there's going to be less government spending, which affects GDP, and an increase in unemployment because he's going to already has done some quite sweeping employment cuts, particularly at the federal level. So I think we're going through a period where the market's trying to work out what does that actually mean for GDP growth. It means slower GDP growth, and that's been reflected in the equities.
Slower growth, but a recession, is that possible in the US?
Very unlikely, in my view. Don't forget that the American economy is still growing at a very healthy clip. And, trend is typically 3, we're around about 2.5. But add in inflation, you've got nominal growth of around 5.5 to even 6. So depending on your forecast for inflation, and we can talk about that a bit later perhaps, but you're looking at a nominal growth of around, sort of 5.5. So that's very, very strong. And to actually get into negative territory, even on a short-term basis, I think is pretty unlikely.
So political risk, clearly a factor there. But what about valuations? We saw particularly the Mag 7 US tech shares becoming quite expensive over the past few years, and a little bit of that has been unwound. So has this sell-off been linked to people just thinking, actually, the US got a bit expensive, time to take some money out? Valuations were a little bit much to us.
Yeah, I think there's definitely an element of that at play, certainly. And I think for me, the bigger question is not so much valuation on its own. It's more, typically equity markets can handle higher valuations if the growth is there. So equity markets really thrive, perform well when there is growth and it's accelerating. And what we're seeing with the top of the market with the Mag 7 is for almost all of those names, you're actually seeing a rate of change deceleration in the growth rate. And that's typically when Mag 7 stocks, or any growth stock for that matter, tends to underperform. And it's funny, it's easy to think of Mag 7R, they've been such heroic, and they have been great. I mean, they have performed well, but they do go through periods of significant underperformance or bad performance. And 2022 was the last time that happened. Don't forget, the S&P was down, I think it was about 28% in 2022, certainly in the mid-20s. And that's a pretty serious correction. And Tesla was down, I think, 75% that year. Google was down 50. So it's not like they are impervious to changes in the growth outlook. And I think that's what you're seeing now. And it's interesting when we talk about tech, again, sort of a very much a beloved sector, and it's been great. But when you look at it, it actually peaked in relative performance terms against the S&P 500 back in the summer, back in June. So tech has sort of quietly been underperforming the market for, 9 months already. So as you add into that the decelerating growth picture for these companies, I don't think, the Mag 7 is really going to be the leadership group from here. And it's as I say, it's already not been leadership for around 9 months.
And of those 7 names or big tech stocks more generally, are there any that you own in your portfolio, or any that actually you think could look quite attractive given the pullback in valuations?
Yeah, so we only own one. We own Amazon, and we have owned all of them, at various different times. Nvidia obviously is one that we owned, but we've been selling out of that and are now completely out of that over the last 2 to 3 months. And again, that's for reasons where the interesting thing about Nvidia is it's quite different from the other Mag 7 stocks because it really is purely a product story. And it's a product story in the most cyclical part of tech, which itself is a cyclical sector. So it obviously sells semiconductors, super high end. We probably all understand the story, but still it is a cycle. And it's great when you're in huge demand, which Nvidia chips obviously have been. But things like DeepSeek, I think, do change the picture. And notwithstanding, you'll always have a cycle. And what I mean by that is when you get to the point where supply starts to be more in balance with demand, then these stocks can really dramatically underperform. So I think you've got to be really careful with a stock like Nvidia that you don't hang on too long and get the down cycle as well as the up cycle. So that's just a bit of a tangent, but just in terms of remembering that all these Mag 7 stocks, although we tend to talk about them as a group, they are wildly different businesses underneath the surface. Amazon we've retained, and will we look to add to the others on? Yeah, I mean, really for me, it's not so much about the actual absolute valuation level. It's more about the growth rate and really the rate of change of the growth rate. That's what would get us back into these stocks, and we don't see that occurring in the near term right now.
So the S&P went into correction briefly, 10% drop. Do you think this is the bottom of this blip, or actually we could be heading into a bear market where US shares in dollar terms drop about 20% or more?
I think that's probably unlikely. What's really interesting is the speed of the correction. As you rightly say, it's 10% practically in a straight line, which in and of itself is unusual. Markets tend to obviously oscillate up and down, but the trend has been quite markedly negative in the last 5 to 6 weeks. And I think it's actually the 5th quickest 10% correction since 1950. So that's a very long time, obviously. So that to me is notable, and I think it's been that dramatic because of the reasons we discussed around complete uncertainty about what the Trump's policies actually mean in the short term. I mean, the longer term picture is, I think what he's doing is absolutely right for the American economy. So longer term, I think, a fiscal clearing of houses absolutely needed to happen, and it's happening. So that's really, really positive. To get to answer your questions specifically, one never knows if it could turn into 20%. I think, as I say, that's unlikely because these things tend to get priced in so quickly, and that's really what you've seen with this sharp drop is a pricing in very, very quickly of uncertainty. So we look at the market not just in terms of looking at the fundamental stories of stocks, but we also use a top-down macro process, which helps us identify turning points in the cycle. And it's a quantitative model, so just numbers, and it really just tracks the rate of change of growth and the rate of change of inflation. And what that model is saying that we're probably still going to have a bit of a growth deceleration in Q2, but past that, we should inflect higher again, and that will be sort of starting, well, basically as soon as sort of Q3's start. So we're still quite cautious near term, but by that I mean a quarter, and we'll be sort of ramping back up in sort of portfolio beta terms in Q3.
Trump's tariffs, how do you see those playing out for different types of businesses? Who are the winners and possible losers here?
Yeah, it's interesting, isn't it? It's quite hard to tell, really. Not least because he keeps on changing what he's going to do and the extent. And we had just had some news over the weekend about perhaps they're going to be less bad. So I think there's certain sectors which are clearly going to be affected. As for actual winners, I mean, the problem with tariffs is it is quite a regressive step. One of the interesting ways we've been sort of talking about it with clients is that everyone assumes that tariffs are going to be inflationary. And obviously that makes a lot of sense because you're making goods more expensive. But actually there's a deflationary or disinflationary angle to it too, in that if you're going to slap a 20% tariff, well, maybe I'll go and buy my whatever I want to buy from somewhere else. And the market is very quick at adapting and changing. So is it actually disinflationary? And one of the interesting things about inflation is that I think most people consider it's likely to be higher for longer, and we wouldn't necessarily disagree with that. But also, don't forget, CPI peaked in January at 3%. So that's 3% pretty low. I mean, the target is 2%, but that's slightly. Anyway, I mean, it wasn't that long ago they were at 9% inflation, so it's already at 3%. And actually, the last reading was 2.8, and our forecasts reckon it will be 2.4 when they report in a couple of weeks' time. So you're actually already seeing a disinflationary reality, despite all the headlines around tariffs. So it's quite difficult to sort of be explicit about winners and losers because there's so much going on there. We're not even sure whether they're going to be inflationary or disinflationary, or possibly they'll both. At the first instance, inflationary and then disinflationary. So it's quite a complicated picture, but we're not trying to go out there and write who's going to win from the tariffs, but obviously very mindful of the effect that tariffs are going to have.
So you split the fund into core ideas and tactical investments. On the tactical side, where are you finding opportunities today?
Yeah, so on the tactical side, we've, in the last couple of months, tactically got a bit more defensive. And so what that means is selling some of our sort of slightly racier stocks, so things in tech and in consumer discretionary, and picked up slightly more defensive shares, so things like AT&T, the telco company, and T-Mobile, they're actually both in quite a good spot fundamentally as well, in that they're taking share from Verizon, which is the third player. But they're much lower beta. That's what I mean by defensive. In markets like we have just had, it's really important to have, in my view, is to lower the beta of the fund so you don't get sort of caught out or lose a lot of upside that you might have had. And you look at stocks. So Tesla was another example of a stock that we owned but sold because it's one of the highest beta stocks in the market. So anyway, that's an example. But on the longer side, or sort of some more longer term side, one share we've been picking up recently is Take-Two Interactive, which is interesting because it is the owner of Rockstar Games, which makes Grand Theft Auto, and that's going to launch. Grand Theft Auto 6 is going to launch in November of this year, and that's interesting because it's Grand Theft Auto, the game, is the most valuable entertainment IP that there is, that's ever been sold. So it's a big event. They last launched GTA 5 was 10 years ago. So it's a much anticipated event, and that's a stock that we think is really interesting. It's held up very well in this recent volatility, and we think it's going to have. They typically do have a really good run into the launch of this game. So quite excited about that as an example of something we've picked up more recently.
And on the core ideas side, is this a bit of the portfolio that you don't really change too much? And are there some companies that you've held for a really long time in there?
Yeah, we do tend to. Yeah, that's the whole idea of the core. Longer term ideas that we can sort of leave and have compound for us. So an example of that would be Axon Enterprises. Axon makes tasers. The sort of non-lethal device used by police forces around the world. It's funny, Taser, because it's one of those companies where it used to be called Taser International. They changed the name to Axon, but it's one of those products where the branding is I mean, everybody knows what a taser is, right? I mean, the kind of thing, but the actual global penetration of the product is actually really quite low. So it's an interesting sort of dynamic there, but they also make body cams. And the really interesting part of the story for me is that the fact that if you narrowed most of their sales are still in America. But what you have today, which is even more important these days, is you have a body cam which will record an arrest, for example, but then they have the AI software backing it up. So that'll automatically write the report of what's happened as per the footage from the body cam. So not only does that save time, they reckon it saves police officers 4 hours a day not writing reports, but there's an accuracy element as well. So that's a really great product, which police forces now in America and also much more globally now really want to have. And from an investor's point of view, it's great because you're moving from a company with a profit margin around hardware into a profit margin around software. And software, you're getting a 20-point margin uplift from sort of 40 to 60 in round terms on that. So that helps the stock work. So that's a good example of a company which we anticipate holding for the long term. We've owned it for about 2.5 years and expect it to continue to perform well as it takes its products to a global audience.
So that's a big success story of AI that goes beyond just buying chips and investing in the cloud. Are there any other examples where companies are actually embracing AI and using it effectively to grow the business?
Yeah, it's a very interesting question because there aren't that many. I mean, lots of companies talk about it. I mean, everybody talks about it, don't they? AI this, AI that, but actually real useful products that you can monetize at scale are still pretty few and far between. I mean, you think about Copilot, the Microsoft AI agent, in effect, isn't very good, doesn't really monetize. I think obviously we can all see the future, the promise of AI is absolutely huge. And I think some areas like healthcare would be, I mean, if you could get this is happening now, but again, it's hard to actually access in terms of investing. But, if you could run all the clinical trials that have ever been done through AI and figure out, some kind of utility that hasn't been tried, that's a huge optimization of existing data, which would almost certainly throw up some really, really interesting possibilities in terms of therapy development. So we can all see, and I think obviously there's lots of other use cases for AI, but to your point, monetization of it today isn't really there. Apart, as you rightly say, I think Axon's a very good example of something that's tangible, usable, works, and is also monetizable.
You own about 30 companies in this fund. Have you been using the sell-off to add new shares or to invest more in companies that are suffering a bit right now?
Well, a new addition to the fund, literally in the last week or two. But yes, we've added to Spotify, which again is a really interesting story that we like because it's a bit like Netflix, which we've also been adding to. But the story there is, really, it's quite interesting when you have a downturn or a correction like we've had, and there's a lot of uncertainty. Consumer discretionary type businesses tend to sort of get it in the neck a bit because people think, oh my God, everyone's going to stop spending. And that to a certain extent can be true. And particularly if we're, got a slightly more challenged economic picture in the near term. But the view very much around Netflix and now Spotify is here are two businesses where people, the stickiness of the user base is incredibly high. So people tend not to churn away. People tend to churn away from other subscription services, but Netflix, again, there is competition there. Particularly in America, you have other entertainment subscription services, but Netflix is the one that everybody, is definitely the last to go if it goes at all. And Spotify has also proved to be really a service that people want to, really have. So that's been areas that we've wanted to add to on weakness. Where else have we been adding? Yeah, we actually some new positions in insurance as well. That's been a part of financials which has been performing well, and the whole financials sector has been performing well, and that's really a lot around rates and the steepening yield curve, and so we've been taking advantage of that as well.
And Trump has pledged to support US businesses potentially through reduced corporation taxes. Is that something on your radar? The positive impact of Trump in office? So, outside of tariffs and the uncertainty around that, there are actually sectors that could really benefit from him and his traditionally pro-business stance.
Yeah, I think so. It's very much, sort of America first, and that has meant, tariffs. But it also, as you rightly say, does mean tax cuts, and it means tax cuts at the corporate level, but also, let's be careful about how we talk about it. It's not really tax cuts, but it's extension of existing tax cuts. So it's not new cuts, but In effect, yeah. I mean, I think that's right. And there's a individual level at taxation, income tax cuts, which are going to get extended as well. So, yeah, I think that's a very positive message. And he's basically using the tariffs to try and pay for those for the extension of those cuts. So, yeah, I think it's a positive step for America and both corporately and for the consumer. And also, there's a real effort to get the industrial base back onshore. You know, this reshoring of, we hear about it quite a lot in terms of the semiconductor industry, building factories to make, called fabs, you know, sort of factories that make chips based in Arizona, based in Nevada. And that does generate a lot of employment. And it's just, you know, obviously also a strategic imperative now that they want to get out of Taiwan and other areas and have it all homegrown. But again, that's a real benefit to the domestic economy. And that's something that Trump really supports. And I think that's a big positive for him.
My thanks to Felix, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions to tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your savings and investments on the Interactive Investor website at ii.co.uk. We'll see you next week.